The pattern described above only becomes fully intelligible once the housing market is placed back into its macroeconomic setting. What looks, on the surface, like a puzzling failure of lower interest rates to reignite house prices is in fact a delayed consequence of a decade-long affordability shock colliding with regional inequality, demographic change, and altered expectations. The cut in Bank of England policy rates to 3.75% has eased monthly mortgage costs at the margin, but has not repaired the deeper damage done to the relationship between incomes, prices, and risk. For most of the post-2008 period, UK housing was sustained by an unusual combination of forces: ultra-low interest rates, expanding credit terms, and a widely shared belief that property prices, particularly in the South, were structurally protected from meaningful decline. This belief mattered as much as any numerical affordability metric. When households assume future capital gains, they tolerate higher price-to-income ratios and stretch further on debt. What has changed since 2022 is not just the cost of borrowing, but the credibility of that assumption. After examining transaction data, survey evidence from lenders, and buyer sentiment tracked by bodies, such as the Royal Institution of Chartered Surveyors, what becomes clear is that confidence has fractured alongside geography. In the south of England, and especially in London, house prices had already drifted far beyond the gravitational pull of local wages long before interest rates rose. ONS figures consistently show median full-time earnings in London roughly 30 to 35% higher than the UK average, yet house prices are often more than double. This imbalance was sustained through global capital inflows, buy-to-let expansion, and parental wealth transfers rather than local labor market fundamentals. Once mortgage rates jumped sharply in 2022 to 23, that model stopped expanding. Even as rates have now eased, the underlying arithmetic has not reset. A slightly cheaper mortgage does little for a household facing a deposit requirement equivalent to several years of post-tax income while paying record rents. This is why price falls in the South are best understood not as a cyclical downturn, but as a slow repricing of expectations. Sellers are reluctant to accept large nominal losses, while buyers no longer feel compelled to rush. The result is stagnation, low transaction volumes, modest price declines in real terms, and a market that appears frozen rather than collapsing. Existing homeowners, particularly those who fix mortgages at ultra-low rates, are often locked in. Moving would mean refinancing at higher rates or crystallizing losses, so mobility falls. This has knock-on effects for labor markets, as workers are less able to relocate for higher productivity jobs, reinforcing regional divides. In contrast, Northern England, Scotland, Wales, and Northern Ireland remain anchored much more closely to local incomes. Although prices have risen strongly in recent years, the starting point was far lower. In many northern local authorities, price-to-earnings ratios remain closer to 4 or 5, levels that still allow first-time buyers to enter the market with conventional borrowing and smaller deposits. Here, lower interest rates do matter, because they interact with an affordability baseline that has not yet been breached. Demand spilling over from the South, whether from remote workers, investors seeking yield, or households priced out of their home regions, adds further upward pressure. This divergence is reinforced by rental dynamics. The contraction of the private rented sector is not evenly distributed. Landlords exiting due to tax changes, tighter regulation, and rising compliance costs disproportionately affect lower-value properties, often in regional towns and cities where yields were already thin. The Resolution Foundation and IFS have both highlighted how this withdrawal reduces rental supply faster than new build-to-rent schemes can replace it. As rents rise in these areas, buy becomes relatively more attractive for those who can scrape together a deposit, intensifying demand and supporting prices. In the South, by contrast, rents may be high, but the step from renting to owning remains prohibitively large for many, muting this effect. The distributional consequences are significant. Younger households without access to family wealth are increasingly excluded from high-opportunity regions, while those in lower-cost areas face rising housing costs without commensurate wage growth. This creates a feedback loop. Affordability pressures push households north or into smaller cities, which lift demand and prices there, while the South experiences demographic hollowing among younger, mobile workers. Over time, This risks entrenching a two-speed economy in which housing ceases to function as a neutral asset and instead becomes a mechanism that reallocates opportunity geographically. Crucially, none of this resolves itself quickly. Housing markets adjust through slow-moving variables, planning constraints, construction capacity, demographic change, and institutional behavior by lenders and regulators. Even if interest rates were cut further, the legacy of high prices relative to incomes would persist. Likewise, a sudden surge in house building, often proposed as a solution, faces structural barriers ranging from land availability to local opposition and skill shortages in construction. The Office for Budget Responsibility has repeatedly warned that supply responses operate over decades, not years. The result is a housing system that no longer responds uniformly to national policy signals. Interest rates, once a powerful single lever, now produce fragmented outcomes. National averages obscure more than they reveal, masking the reality that the UK is no longer experiencing one housing market, but several, moving at different speeds and governed by different constraints. If current trends continue, the most likely outcome is not a dramatic correction, but a prolonged period of divergence in which wealth accumulation, mobility, and economic resilience depend increasingly on where households are anchored. This fracture marks a turning point. Housing is no longer simply a reflection of the business cycle. It has become a structural amplifier of regional inequality. The longer affordability remains stretched in the South and erodes in the North, the more difficult it becomes to restore a coherent national market. What follows from this is not inevitable collapse, but a gradual redefinition of who housing works for and where. When you are ready, I can continue with the second response, building directly from this point. What follows from this growing regional fracture is a quieter but more consequential shift. The way housing now reshapes labor markets, household risk, and long-term economic capacity. The housing market is no longer merely reflecting regional economic differences. It is actively producing them. Once affordability diverges beyond a certain threshold, it begins to alter behavior in ways that compound the original imbalance. One of the clearest mechanisms is labor immobility. For much of the late 20th century, high-productivity regions, such as London and the Southeast, acted as magnets. Workers, particularly younger ones, moved towards opportunity, accepting higher housing costs in exchange for stronger wage growth and career progression. That mechanism is weakening. ONS internal migration data shows a sustained net outflow from London since the pandemic. But what is notable is not just the scale, but the composition. Those leaving are disproportionately under 40 and without children, precisely the cohort that once replenished the city's workforce. Housing affordability sits at the center of this shift. When median rents absorb 35 to 45% of net income, as they now do for many private renters in London and parts of Southeast, the risk profile of moving changes. A job opportunity that once represented upward mobility now carries the threat of financial precarity. This is particularly acute in sectors with volatile hours or delayed progression, creative industries, early career professional services, public sector roles, which are disproportionately concentrated in high-cost cities. The result is a subtle filtering effect. Only those with existing financial buffers, family support, or dual incomes can take advantage of these labor markets. At the other end of the country, rising house prices in northern regions initially appear to signal convergence. On paper, stronger demand, higher prices, and inward migration suggest economic rebalancing. But after examining wage data from the annual survey of hours and earnings, what becomes clear is that price growth is outpacing income growth even in these lower-cost regions. This matters because it risks importing the same affordability constraints into areas that lack the wage dynamics to sustain them. If housing costs rise without corresponding productivity gains, households become more leveraged without becoming more resilient. This has implications for household balance sheets. First-time buyers today are taking on larger mortgages relative to income and for longer durations. The shift towards 30 to 35-year terms is not simply a financial innovation. It is a structural adaptation to unaffordable prices. While longer terms reduce monthly payments, they extend exposure to interest rate risk and delay wealth accumulation. A household that enters homeownership in its mid-30s on a 35-year mortgage is still servicing debt well into retirement age, unless wages rise faster than expected or assets appreciate strongly. That assumption is increasingly uncertain. This change in risk is unevenly distributed. Homeowners who bought before 2015, particularly in the South, often sit on substantial housing equity despite recent price stagnation. They are insulated from rent inflation and, if they fix mortgages at low rates, from higher borrowing costs in the short term. Younger cohorts, by contrast, face a housing market that demands higher upfront capital, greater leverage, and more compromise on location and quality. The intergenerational divide is therefore not just about wealth levels, but about exposure to uncertainty. The rental market amplifies this divide. The contraction of the private rented sector has removed flexibility from the system. Renting once functioned as a transitional tenure, imperfect but mobile. As supply tightens and rents rise, renting becomes both expensive and insecure, while ownership remains out of reach. This traps households geographically. Workers may remain in unsuitable or lower-paid jobs simply to maintain housing stability, reducing labor market dynamism. Over time, this depresses productivity growth, a problem the UK already struggles with by OECD standards. There is also a fiscal dimension. Stamp duty thresholds, council tax bans, and housing benefit caps were designed for a housing market that no longer exists. In high-price regions, transaction taxes discourage mobility further, while in lower-price areas, rising rents push more households toward housing support without a corresponding increase in supply. The Institute for Fiscal Studies has repeatedly noted that housing benefit spending is driven more by rents than by claimant numbers. As rents rise in cheaper regions, the cost of the exchequer follows, even if employment remains high. Taken together, these forces suggest that the housing market's fracture is beginning to feed back into the wider economy. Reduced mobility weakens matching between workers and firms. Higher housing costs divert income away from consumption and savings. Longer mortgage terms extend financial vulnerability across the life course. None of these effects trigger sudden crises, but they exert a persistent drag. Growth slows not because of a single shock, but because the system accumulates friction. What makes this particularly difficult to reverse is that many of the drivers are endogenous. High prices reduce mobility, which limits supply responses and reinforces regional inequality, which in turn sustains uneven demand. Planning reform, often proposed as a solution, addresses only one constraint and operates slowly. Interest rate cuts, meanwhile, risk reigniting demand in already pressured regions without restoring affordability. The levers that once worked cleanly now produce asymmetric outcomes. The housing market, then, is no longer a stabilizing asset class underpinning household confidence and economic momentum. It has become a selective filter, allocating opportunity, risk, and security unevenly across regions and generations. This does not imply imminent collapse, but it does mark a departure from the assumptions that shaped policy for decades. If housing continues to function this way, the questions shift from how to fix the market to how the economy adapts to a world in which housing no longer reliably supports growth, mobility, or social cohesion. As these pressures accumulate, the longer-term implications become harder to ignore. Housing is no longer just shaping who can buy or rent. It is beginning to redefine how the UK economy allocates capital, how households plan for the future, and how policy choices interact with entrenched constraints. What emerges is not a market awaiting correction, but a system settling into a new, less flexible equilibrium. One of the most underappreciated consequences of the current housing configuration is its effect on investment behavior, both at the household and national level. For decades, housing absorbed a disproportionate share of private investment. Rising prices encouraged households to channel savings into property, either through homeownership itself or buy-to-let. This was not necessarily productive in the narrow economic sense, but it supported consumption through wealth effects and underpinned a sense of financial security. As price growth stalls in the South and becomes less predictable elsewhere, that dynamic weakens. Housing ceases to feel like a dependable store of value, yet alternatives for long-term household saving remain limited. At the same time, the retreat of small landlords and the concentration of new rental supply in institutional build-to-rent developments subtly alters who controls housing assets. Large-scale investors tend to focus on major urban centers where scale, liquidity, and professional management make projects viable. This leaves smaller towns and peripheral regions increasingly exposed to supply shortages because neither institutional capital nor small landlords find these areas attractive under current regulatory and tax conditions. The result is a patchwork rental market, professionally managed, higher-cost developments in some cities, and acute scarcity elsewhere. This unevenness reinforces regional divides rather than smoothing them. From a macroeconomic perspective, the housing market's fragmentation complicates policy transmission. Monetary policy, in particular, now operates through weaker and more distorted channels. When rates fall, the intended boost of borrowing and spending is blunted by deposit constraints, stretched price-to-income ratios, and risk-averse lenders. Conversely, when rates rise, the pain is concentrated among recent buyers and renters, while older homeowners remain relatively insulated. This asymmetry reduces the effectiveness of interest rates as a stabilizing tool. The Bank of England can influence aggregate conditions, but it cannot easily address the distributional consequences that follow. Fiscal policy faces similar limitations. Subsidies for first-time buyers, stamp duty holidays, and shared ownership schemes all attempt to bridge the affordability gap without addressing its source. Evidence from the OBR and IFS suggests such measures tend to be capitalized into prices where supply is constrained, benefiting existing owners more than new entrants. Over time, this risks locking policy into a cycle of intervention that sustains prices while failing to restore accessibility. The political appeal of supporting homeownership remains strong, but the economic returns diminish as affordability worsens. Demography adds another layer of inertia. The UK population is aging, and older households are far more likely to own property outright. This cohort has little incentive to support policies that might reduce house prices, even if such policies benefit younger generations. Meanwhile, younger households delay family formation, homeownership, and long-term financial commitments, not out of preference but constraint. These choices have downstream effects: lower fertility rates, different consumption patterns, and altered demand for public services. Housing affordability, once a private concern, increasingly shapes demographic and fiscal outcomes. There is also a psychological shift underway. For much of the late 20th and early 21st century, homeownership was framed as a default aspiration and a marker of adulthood. As that pathway narrows, expectations adjust. Survey data from bodies such as the Resolution Foundation shows younger adults increasingly skeptical that owning a home will materially improve their financial security. This matters because expectations influence behavior. If housing is no longer perceived as a reliable ladder, households may save less, invest differently, or disengage from long-term planning altogether. These effects are diffuse, but they accumulate over time. Importantly, none of this implies an imminent collapse or a dramatic reset. The UK housing market is characterized by stickiness. Prices adjust slowly, supply responds sluggishly, and institutions adapt incrementally. This is why the current situation feels unresolved rather than explosive. The system absorbs shocks by spreading them across cohorts, regions, and time. But absorption is not the same as resolution. The cost is paid in reduced mobility, weaker productivity growth, and widening inequality. Outcomes that are gradual enough to evade crisis narratives, yet persistent enough to reshape the economy. What becomes clear, after examining these interacting forces, is that the housing market's fracture is not a temporary distortion caused by recent interest rate volatility. It reflects a deeper misalignment between housing costs, incomes, and policy frameworks that evolved under very different conditions. Restoring a single, coherent national market would require changes that are politically difficult and economically slow. Sustained house building in high-demand areas, reform of land and planning systems, and a rethinking of how housing is taxed and subsidized. Even then, the legacy of past price inflation would linger. In the absence of such shifts, adaptation becomes a default. Households adapt by moving later, borrowing longer, or relocating further from opportunity. Firms adapt by widening recruitment pools or accepting higher turnover. Government adapts by managing symptoms rather than causes. None of these adaptations are irrational, but together they signal a lowering of ambition, a quiet acceptance that housing will no longer function as it once did. The UK housing market, then, is not simply broken in the sense of malfunctioning. It is operating according to incentives that no longer align with broad-based prosperity. Regional divergence, affordability constraints, and altered expectations are not side effects. They are the system's current equilibrium. Understanding this is crucial because it reframes the debate. The question is no longer when the market will recover, but what kind of economic and social landscape emerges if it does not, and who bears the weight of that adjustment over the decades to come.